Hello, everybody. My name is Vanessa Turnball-Kemp. Today, I'm going to be taking you through some of the amendments that have taken place via the budget speech that happened at the end of February. From an international tax point of view, there were not many tax amendments that took place. From an international tax perspective, it was mostly just a few small changes to clarify certain things in the legislation. There haven't been any big changes made. So this section should be fairly short. I'll take you through the small changes that have been made. The first one relates to the definition of a foreign dividend. So as you know, a foreign dividend is currently defined as an amount paid by a foreign company in respect of a share in that foreign company. So this definition at the moment specifically excludes any amounts that constitute the redemption of a participatory interest in a portfolio of collective investments from being provided as a foreign dividend. However, in terms of foreign law deals not only with redemptions, but also the sale of units, shares, or interest to the foreign management company of the scheme. So from a South African perspective, it's been proposed to amend the definition of a foreign dividend to take into account these redemptions of a participatory interest in a portfolio of collective investment, so that those disposals will also then be considered as a foreign dividend and would then qualify as a foreign dividend for South African tax purposes. There were a number of small amendments made to the controlled foreign company rules. I don't think it would be a tax year if there weren't some small amendments made to the controlled foreign company rules. They are quite small changes, which I think comes as a relief to everybody this year, but nevertheless, a few changes in any event. The first change is in respect to the definitions and terms relating to the Insurance Act. The Insurance Act came into effect on the 1st of July 2018. The new Insurance Act deleted and inserted certain new definitions. One such definition is the definition of a linked policy. Section 9D of the Act, the CFC section of the Act, contains an exclusion which excludes the participatory interests held by an insurer in any policyholder fund, which are directly attributable to a linked policy. And these are then excluded from the CFC imputation requirement. So because the definition of a linked policy and certain other definitions in the Insurance Act have changed, amendments will be made to the definitions in Section 90 to align with the new Insurance Act so that the Insurance Act and the CFC rules and regulations speak to each other. Another change that's going to be taken place is the deeming provisions in Section 9B will be extended to cater for royalties derived by CFCs. So as you know, the most important rule contained in the CFC provisions is that the net income of the CFC must be calculated as if the CFC is a taxpayer for South African tax purposes and as if that CFC is a resident for South African tax purposes when you're looking at certain provisions of the South African Income Tax Act. So for example, a CFC is deemed to be a resident in relation to interest derived from a South African source. However, Section 9D2 Cap A does not mention royalties derived by the CFC. So because of that gap, it could be interpreted that royalties would still qualify for the exemption in terms of Section 10(1)L of the Income Tax Act. So this amendment has just been brought in to make it clear that the royalty exemption contained in Section 10(1)L of the Act will not apply to a CFC. So that CFC will be regarded as a resident in terms of royalties, and therefore royalties from a South African source will not be exempt in the hands of a CFC. Another small CFC amendment is just clarifying the treatment of amounts from hybrid equity instruments deemed to be income under the South African rules. So the CFC rules contain an exclusion which is applicable to payments made between two CFCs. This normally relates to interest, royalties, insurance premiums, and similar income. This income will be exempt, so from an income and an expense point of view, provided the payer and the payee are part of the same group of companies. In terms of the hybrid equity instrument rules, certain dividends in relation to the recipient are deemed to be income. So to ensure that there's neutral tax treatment, it is proposed that these interest CFC rules are extended to make specific reference to the exclusion of the payee companies deemed income or hybrid equity instruments between CFCs. So it's basically just saying if you've got the deemed dividend under these rules, and it's between two CFCs forming part of the same group of companies, that it would qualify for the interest CFC exemption. There were a few changes made in terms of exchange control. There are just two that are quite interesting, or at least one that's quite interesting from an international tax point of view. That is in relation to domestic treasury management company. So as you know, a domestic treasury management company itself is outside of the exchange control net, but transfers from a South African parent company to a South African domestic treasury company would still fall within the South African Reserve Bank rules. Now, the South African Reserve Bank has extended the blanket approvals for transfers made by a parent company to its South African domestic treasury management company. For listed entities, the blanket approval has increased from 3 billion rand to 5 billion rand, and from 2 billion rand to 3 billion rand for unlisted entities. Another point that we just wanted to point out at the moment is in respect of loop structures. So previously, the South African Reserve Bank issued a circular allowing loops to be created. So basically, South African assets to be externalized, even when they're ultimately held by South African residents. It appears via some interactions we've had lately that the South African Reserve Bank are backtracking on this a little bit, and they are pushing back on some instances where loops are being created and approval is being sought for these loops. The South African Reserve Bank has indicated that it was never their intention for South African assets to be externalized. So there is a bit of mismatch between what the circular seems to say and what the SARB understands that they wanted it to say. So we are hoping that some clarity is issued on this soon. I think a lot of companies would like to take advantage of this. So hopefully there will be some clarity issued on this soon. Thank you very much. That was it from an international tax perspective for this budget season. I'm sure when the Tax Amendment Act comes through, there'll be a few more things to share in this space. Thank you very much.